the concept of net working capital is meant to track the structural value of working capital assets netted against structural working capital liabilities. So I just want to put a numerical example to this. So let's say we have accounts receivable of $100 at some point in time. How did that, all else equal, how does that affect our cash? Like, how does having an additional $100 of accounts receivable impact our cash balance?
So you are out $100.
Yep, exactly.
Of your cash.
Exactly. So having all else equal an extra $100 in accounts receivable means that our cash balance is $100 lower.
Mm-hmm.
Same question for accounts payable. Let's say we have all else equal an extra $100 in accounts payable. How does that impact our cash balance?
So you have an extra $100 that eventually will be lost.
Yeah,
or
exactly.
be paid.
Exactly. But we haven't paid it yet.
Correct.
So how does that impact our cash balance today?
So it would cancel each other out. It'd be zero.
Yeah, exactly. So if you layer on both and just layering it on one at a time. So if all else equal, you have accounts payable that is $100 higher,
mm-hmm.
your cash balance is $100 higher mm-hmm. because it's money you otherwise would have had to pay, but you've just delayed when you owe it. And so now if we, exactly as you said, Blaze, if we combine them both together and our receivables are up by $100, our payables are up by $100, the net of those two things is that they cancel each other out when we think about our cash balance. So that's the concept of net working capital, is if you take the sum total of, these things that are called current assets, so accounts receivable, inventory, prepaid expenses, these are all current assets. And we subtract them from the current liabilities that flow into working capital, we get a net working capital number. And so almost always you'll see that working capital and that net working capital is a drag on companies' cash flow. So more often than not, at any given point in time, a company is waiting for more money to come to them than they, at any point in time, have delayed paying that they owe to somebody else. That said, this is why people like to pay attention to working capital, because if that net working capital number is usually positive, meaning the value of the assets that are part of working capital outweigh the part of working capital that's liabilities, you'd think hey, more assets than liabilities, that's a good thing. But in this case, these are things that we expected to be cash, but aren't yet. So having more assets that are not yet cash is bad for our actual cash balance. And so if our net working capital is structurally positive and increasing over time, then that reduces our projected free cash flow, all else equal, just based on what we thought, from the net income projections.
Are there differences in what might be considered like a good or a healthy working capital across industries? You mentioned for software, someone like Oracle might have a lot of deferred revenue, but might that differ, depending on what the company does?
It definitely does vary by sector, yes. And it varies by sector, it varies by business model, and it varies again by the competitive dynamics in the business too. So all of those things are definitely important parts of the equation. And it's also a reason why if you can find a company that has a structurally negative net working capital, which is to say that structurally their current liabilities exceed their current assets, then working capital is actually a source of funding for the business. So an example would be what happens if you were so typically the way you'd run your lemonade stand is you would go out, you'd buy your supplies, you'd hire somebody, and you'd pay them, on an hourly basis. Maybe you pay them at like daily to like go man your lemonade stand booth. And so you're out all of this cash before you've ever made a sale. And so if you were trying to start that version of this lemonade stand business, you need to go out and get money from somebody to start this whole thing, right? Like you either need to borrow some money and, and have some debt, or you need to give somebody, or promise them a percentage of your future profits for, some cash that'll be equity. So your funding for the business has to come from debt or equity capital, because you need to pay all those upfront costs before you're generating revenue. But now let me give you another example. What if you got prepayments from people who are like, hey, like Olivia, you seem like you make amazing lemonade, or maybe I've even had like some lemonade that you made in the past. Like you need to start a lemonade business. And all of these customers are so excited about the prospect of you starting this lemonade business that they're going to prepay you for lemonade that they're going to buy the next weekend. So you get paid upfront. Everybody's giving you like whatever, like $3 for a cup of lemonade on Monday. And then once you've received all those prepayments on Tuesday, you go and buy the ingredients. You hire somebody, and then you give everybody the lemonade on Saturday. So in that case, you would have had net negative working capital in that period, right? Because in that case, actually, which line item would that fall into? If people are paying you in advance or prepaying you,
wouldn't it be in the accounts payable, because you technically owe that since they've already paid you?
What do you owe? Do you owe money, or do you owe a product, or do you owe work?
You owe the product.
So it's not accounts payable, because accounts payable is money you owe.
Okay. So then could it fall under accrued expenses, or would that be in the cash line as well?
So accrued expenses are things that you've benefited from.
Oh, it would be deferred revenue. Sorry.
Yeah, exactly. It's deferred revenue. It's money we've already received for goods or work that we owe. So in this case, people paid us a bunch of money up front, and we don't get to count it as revenue until we actually sell them the thing. That's the whole kind of idea behind revenue and revenue recognition, is you need to have a contract for something, or an exchange, some kind of payment or exchange. And then like the physical thing, like the good or service, has to be exchanged too. So in this case, we have the contract where people are giving us money up front for the lemonade, but because we haven't actually delivered the lemonade yet, we don't get to count it as revenue until we've actually delivered the product. So as a result, it goes into this category called deferred revenue until we deliver the thing, and then we get to count it as revenue. And in the kind of typical, and actually, I like that we're categorizing things. So in the case where we aren't getting prepaid for things, like what if we have to go out, we like borrow some money, and we buy all our lemonade ingredients, we set up the lemonade stand, we like hire a person, and we aren't, so we're paying for all the goods up front, and then we're selling lemonade throughout the day, and then at the end of the day, we pay the person who's been manning the lemonade stand. Are there any accounts receivable that we need to track in that example?
No.
Right. We would only need to track accounts receivable if customers delay when they pay us for the lemonade. So if we gave somebody a cup of lemonade and they'd say, hey, like, I know it's $3. I don't have any money right now, but I'll pay you tomorrow. then we have a day of accounts receivable where people would owe us the money. What about inventory? Do we have any inventory at any point in this example?
Well, when we have, like, I guess at the beginning of the example, when we've made all of the lemonade, but we haven't sold it yet.
Exactly.
Wouldn't that count? Yeah.
Exactly. Any prepaid expenses?
When we first pay for all of the, I guess all of the products, but we haven't sold anything yet.
So that actually counts as inventory. As soon as we're buying something that is directly going into the thing that we're selling, that counts as inventory. Prepaid expenses, like this is like going to be a lot less common. Like it'll happen, but the dollar number will be like a lot smaller than these other ones. So this would be, maybe like if you're renting a table that you're going to use and you pay upfront for the table, but you haven't actually like used the table as part of like selling the stuff yet or something like that. Because the table isn't really part of inventory. That would be an example of how we track something like that. Any accounts payable?
No. Or were you lended the money in the beginning of the example?
We
For
are we are borrowing
Mm.
money. So somebody is lending us money in this example, but that counts as debt. That's not working capital.
Okay.
The accounts payable line item, there is something in here.
Would it be the money that you owe to, I guess, the people who are working the lemonade stand?
Exactly. It's to the worker for basically intraday. There's a point in time where they're doing work for you and you haven't paid them for that work. Yeah, exactly. And by the way, like I could see how you might argue that accrued expenses, like that maybe that could be an accrued expense because it's kind of a similar thing to accounts payable. Like you've benefited from something, but you haven't yet paid for it yet. In my head, I tend to think of accounts payable as a category of things that are core to performing day-to-day business activities. So that's like includes like employee salaries, whereas accrued expenses might be like if you hire a lawyer to like set up an LLC for you that will be like the legal entity that this lemonade business operates under. And they do that work and they set it up for you, but you haven't paid them. It might be something like that. Like the difference between payables and accrued expenses are a little funny.
Would an example of accrued expense be like if a friend gave you a table, said, use this table for lemonade stand and pay me at the end of it?
Yes, that would be a good example. Yeah, exactly. But in the vast majority of cases, you're looking at accounts receivable, accounts payable. Every business has both of those. Deferred revenue, it's great if a business has that because that means you're getting paid up front. And I think like software businesses, again, classic example where you tend to see a lot of that. And then inventory is bad, by the way, right? Like if you are a business that structurally holds a lot of things in inventory, then that means you've spent a lot of money on all of these things that always take you a long period of time to sell. That is one reason, by the way, where you see end of season sales, like the best time to buy like new skis is in like June, because companies have all of some of it is that they try to restock things with new stuff every year, but you can imagine a world where companies are like, hey, like we just won't sell skis in the summer and we don't try to sell skis in the summer, and we just like starting in October will sell the new skis and we'll also sell last year's skis. But they're carrying all of that inventory and that's just like staying there over the summer. And so oftentimes companies will be willing to sell things at a discount just to clear their shelves, clear their inventory, and reduce the average time that things stay in inventory. Because by the way, the risk with inventory too, especially in that example, is that you produce a lot of goods that you expect to sell, and then you never do. A great example of that is McDonald's Happy Meal figurines are frequently topical in nature. So like if there's a new Star Wars movie coming out, there'll be a lot of little like Star Wars figurines with the Happy Meal. And if McDonald's doesn't produce enough inventory, like if they don't order enough, then there are a lot of unhappy kids who like everybody wants like a Baby Yoda, but they're out of Baby Yodas because everybody wanted Baby Yoda. And then you have unhappy kids. On the other hand, if you order too many Baby Yodas, they're going to get thrown out, and you will have spent all that money on inventory that'll never get used, and you just have to write off and eat that cost.
The Bud Light, how Bud Light has been under fire for their commercial, and now whenever you go into a supermarket or whatnot, they have like a $15 rebate whenever you buy our product. It seems like they're just desperately trying to get it off the shelf.
Two interesting points on this. One, yes, that's exactly right. And by the way, that inventory is not Anheuser-Busch's problem, or like, I guess it's AB InBev is the parent company now. It's not AB InBev's problem because they already sold the beer to the stores. And these stores are trying to get this Bud Light off their shelves so that they can restock those shelves with a different item that will sell. So this is also starting to blend inventory with strategy a little bit, because as a supermarket, you ideally want to sell items that turn over quickly so that people are taking things off the shelves, you're restocking it, and people are buying those things. And you also want to maximize how much you sell, or I guess how much you make on each thing. Consumer goods, it's like a fascinating category, and there's like a ton of complicated stuff. Which is like the next part of this is it sort of is AB InBev's problem if the supermarkets aren't selling enough Bud Light, because they're going to get really mad at InBev and say, I don't know if I want to keep buying your stuff if it's stuck on my shelves. And so that might hurt InBev's sales of like regular Budweiser. I think like Goose Island IPAs is also an InBev product. I think they own Goose Island. And so you might see a world where if Coors Light starts selling a lot more than Bud Light or Modelo, I think I just read is now the #1 beer in the US by sales. And I think Modelo is a brand that is part of Constellation Brands. I think that's the parent company that owns Modelo. But assuming that's true, now there's all of these like supplier dynamics where Constellation is like, great, you want more Modelo? Well, if I'm going to sell you more Modelo at like the same price, then you know what? Like, I'd love if you could reserve some extra space on your shelves for Corona, because I want you to start, selling Coronas too. And so that's where you might see knock-on effects. This has nothing to do with working capital, but it's like fascinating business strategy where you might start seeing like the rise of Modelo relative to Bud Light might lead also to a secondary effect where Coronas start selling more than another lager that is controlled by InBev. So I think it's very topical for this pod. Like once we get through a lot of these technicals, there's all sorts of like fascinating like finance and like business strategy stuff that we're going to spend more time talking about. Part 2 on inventory that I think is really fascinating is, do you notice structural changes in prices in beer often? Like, for example, the question is like, how big of a problem is it that Bud Light might now be sitting on a grocery market shelves for on average for a week instead of on average for 4 days? Like, does that materially impact the product when somebody buys it? Like, do you check expiration dates if and when you buy it?
Rarely.
What about something like flowers? What if like what if, tulips had a PR nightmare? Like maybe there is a new report that talks about how environmentally unsustainable tulips are relative to roses. And all of a sudden now, like, a lot fewer people want to buy tulips. Is it bad if like fresh flowers are sitting on the shelves for an extra 3 days?
Absolutely.
Yeah. And so that's where shelf life and inventory, or, we were talking about the McDonald's example, shelf life of pop culture relevance is definitely a strategy problem that people worry about when they think about inventory planning. So that is to say, I think in the Bud Light example, you won't see people throwing out you won't see stores throwing out cases of Bud Light because of this change in demand. You likely will just see they'll try to sell it as quickly as they can and then drastically reduce their pace of new orders. It's also, by the way, why you see prices of roses rise a lot around Valentine's Day or Mother's Day, whereas prices of beer don't really change around like the Super Bowl or like 4th of July or like major holidays. Because if the week before 4th of July, every supermarket doubled the price of beer, what would people do? Well, 2 weeks before 4th of July, they'd stock up on beer. Whereas with flowers, you kind of need it in the moment and they age. And so, yeah, lots of fun strategy implications of all of this stuff. And working capital is no exception.